Hi there, and thanks for joining us on PhillipCapital Market Watch. I am Chow Han, investment consultant from Phillip Investor Center. As things get heated up in the US presidential election that took place this week, let us take a step back and understand what has been done with the US economy so far. To begin, let's look at what the US government has done to help its economy. The Coronavirus Aid, Relief and Economic Security Act, also known as the CARES Act, is a $2.2 trillion economic stimulus bill. The stimulus package was a response from the US government to the economic impact of the COVID-19 pandemic in the United States. The details of the stimulus package include cash payment to American citizens, unemployment benefits, and funds for small and medium-sized companies. These funds also include large corporations as well as state and local government. Below is a brief timeline of the relief packages that has been provided by the US government thus far. The CARES package is the largest economic stimulus package in US history. It amounts to approximately 10% of US gross domestic product. The CARES stimulus package is also 3 times larger than the stimulus package provided during the 2008 financial crisis termed the Great Recession. Now moving on to interest rate environment, in the years before the 2008 global financial crisis, interest rate in the US was about 5%. After the Great Recession, the Federal Reserve started quantitative easing and brought interest rate close to zero. Interest rate remained low until 2015 when Fed began slowly increasing rates again. Between 2015 to 2018, there were a total of 9 rate hikes. The rates were then kept constant before it was cut 3 times in August, September, and October of 2019, each time by 0.25%. Due to the COVID-19 pandemic, rates were drastically reduced and is currently near zero. Low interest rate will help to boost the economy during times of recession. With lower interest rate, there will be reduced incentive to save and hence encourage consumption. As financing costs will also be lower, firms and corporations will be more willing to take out loans for investment, thereby helping the economy. However, a low or near zero interest rate will make it harder for the Federal Reserve to use monetary policy to combat any economic shocks. So, what about inflation? Federal Reserve recent change of stance from inflation targeting to average inflation targeting means inflation could be higher than the target of 2% in certain periods. Previously, inflation targeting would treat past target misses as bygones. However, with average inflation targeting, the Fed would aim to return inflation over some period to the average of 2%. Average inflation targeting could then help raise inflation and prevent a possible deflated economy. What does the low interest rate and higher inflation mean for everyone? In general, low interest rate and higher inflation makes saving money less attractive, as the same amount of money will be worth less in the future due to inflation. With near zero interest rate and the expectation of the Fed allowing inflation to move up higher in the near future, investors will need to rethink the idea of holding cash. As such, we have seen the stock market recovering and progressively moving up despite the poor economic outlook caused by the COVID-19 pandemic. Assets such as equities and housing may serve as alternative sources of protection from near zero interest rate and higher inflation. In conclusion, holding cash may not be the best option in the foreseeable future. Investors seeking returns will need to manage their risk appetite and invest in assets that will satisfy their investment goals and objectives. That's all for PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Also, tell us what you think. Is holding cash the right way to go in the near future? Leave your comments. Thanks for joining us and see you soon.